All right. So let me just go quick to where we ended, if I remember well. I think we're looking at because we looked at audit risk, then we also looked at business risk, and then we pushed and we started looking at risk assessment. So I'll just start from risk assessment. Okay. So risk assessment, uh, these are procedures carried out by the auditor which allow them to understand the entity and its business. So risk assessment is just a series of procedures that the auditor puts in place so they can have an understanding of the client's business. So that when they have an understanding of that client's business, it can aid the formulation of a plan on which we're going to uh, approach the audit. So either we're going to just test the controls, or maybe we're going to carry out a full substantive testing. So this comes from us analyzing the level of risk that is associated with the particular client. So risk assessment attempts to understand the following. So one, the client's nature of business. So we need to understand what business industry is the client operating in, right? We need to understand the products and services of that particular client. So if we understand the particular industry, the products and services, we can be able to understand which areas that we can focus the audit on. So for example, if our client uh, is maybe a store, right? It sells perishable goods. For example, Zambif, right? So if it's Zambif, the foods that they sell, they are perishable. So now, us as auditors, we need to focus attention on seeing if or assessing or examining if that inventory that they have of these meats, you know, is actually well, or it's actually available, or it's in a form that can be sold, because perishable goods are easily they easily get rotten, and in a statement of financial position there might be an amount of inventory which doesn't exist. So if we understand the client's business and we understand the nature of its operations, we can be able to know where exactly we can focus the audit. Then two, we need to understand the industry, the regulations, and the regulatory framework. So right, we need to understand that entity's industry, right? So we understand the industry. What industry is it operating in, right? Is it a service industry, or is it a service business? Is it um, a product-based business? Is it in the banking sector? Is it in the transport sector? Is it in the retail sector? So if we understand that, we can be able to have knowledge of the rules and the regulations that are surrounding a particular industry. So for example, if we're auditing a bank like Zambia Industrial Commercial Bank. Banks are highly regulated. So if we understand the industry of the client and we also understand the rules and the regulations, we can be able to know exactly where we're going to focus the audit, right? Then internal controls. We need to understand the control activities that are relating to the client. What activities does the client put in place which make sure that all aspects of the business are functioning as appropriate, right? We need to understand those control activities. So if we discover that the control activities that the client has, they're not efficient, then we can make a decision saying, okay, probably this company is a high risk company. So what do? We need to carry a full substantive testing. So by understanding the controls, right? How do management monitor those control activities, right? And what's the attitude of management towards having a strong system of controls? So if we understand all those aspects, again, it's going to allow us to channel focus to a particular area of the business. Then also get an understanding of the strategies, objectives relating to business risks. So what are the objectives and the strategies of the particular company? While auditing young fuels, what are the strategies and objectives of young fuels? So if young fuels, their objective is to maybe provide goods and services at a low price, right? then we need to understand the strategies that that company is using in order to achieve those objectives. And when we understand that, then we can use that information to channel focus of the audit towards areas that may affect the achievement of those objectives and strategies, right? Then also financial performance. We need to know the financial performance. What are the key performance indicators, the KPIs? What are the key critical success factors of the company? What are the budgets? How much did the company budget to make next year? What are the forecasts? So once we understand the forecasts and the budgets, then we can be able to assess and analyze where we can focus our energies in terms of auditing the client and its business. Okay, so now we're trying to get an understanding of the risk associated with our client, right? What methods should be used to gain that understanding? So one, we can use inquiries. And two, we can use analytical procedures. Three, we can use observation. Four, we can inspect the books of the client. So in auditing, these four, they're going to be coming across them when we're looking at tests for controls or substantive testing. These four elements, you're going to come across them. And as you practice them, they're going to be second nature. It's going to be easy. You won't even be thinking about it. You'll be easily making your points using these key aspects, which is inquiry, analytical procedures, as well as observation and inspection. So if we want to assess the risk associated with the client, we inquire. I think this is it the spelling for inquire? I think there's I here. So we need to make inquiries, right? And this involves asking officers of the company or employees relevant questions so as to obtain further information important to the audit, right? So inquiry simply means we go to the client's business, we ask them. So for instance, we're trying to understand the laws and regulations that surround that particular company. How do we know that? We can go to the legal officer, we can go to the lawyer and ask them. We just ask them, oh, Madam Lawyer, what are the rules and regulations which govern your particular industry in your company, right? Are there any pending litigations, right? Have you made any payments in relation to any lawsuit that you've been given, well, that you've received rather, you know? So just asking around. We also ask employees of the company, right? Uh, how do you manage your inventory, right? Do you have CCTV here? So that's what inquiry is. You just go to the client's business and you ask relevant questions which are going to inform that particular audit that we're about to undertake. Then two, analytical procedures. So analytical procedures just involves evaluating financial information as well as analyzing relationships between financial and non-financial information. In simple terms, analytical procedures can simply mean comparing information, right? We just compare information, you know, just simply as comparing information. Those are analytical procedures. Or we can also use complex statistical comparisons like ratios. You understand? So we can compute, let's say, the receivable days, you know, the receivable collection period. We calculate the ratio for this year, the receivables collection period, then also calculate the receivables collection period for last year. Then we compare. So if we make that particular comparison, we can be able to assess and understand where the risk is associated, and we can know where we can channel our efforts in relation to carrying out the audit. So I'll dive deep on the receivables example. So if this year's receivables, they are lower by a large percentage relative to last year, then it means there might be issues of us not being able to put in place, rather the company or the client has not put in place concrete controls for collecting their money, such that they're having a lot of bad debts or they are incapable of collecting their money. So that's a problem, and it can affect the going concern of the entity. So we have to focus effort on assessing and analyzing and checking the receivables of that particular client. And that's what analytical procedures talk about. Then observation. So observation is self-explanatory. It's just the auditor being present when the employee is carrying out their work. So for instance, we're carrying out risk assessment. We go to the client's business, right? Then we sit and just observe. You know, they're carrying out their day-to-day business, right? So for instance, we are auditing a retail store. So we just observe the cashier. How is the cashier uh, carrying out his or her job? You know, uh, are there any segregation of duties? Is the same cashier who receives the payments? When they receive the payment, is it the same cashier who goes to the bank and deposits the money? So we just sit and observe what's happening in the business. If it's a warehouse or it's we just go to that particular warehouse, we sit and we observe, right? We just check what's happening there. Is there any security of some sort? You know, uh, does the client have any locks on the doors to protect the inventory? All right. So we just go and we observe. And when we observe, we go back to the office and we present our observations, and that's going to help us assess the risk of that particular client, and we'll be able to create the appropriate audit plan as well as the strategy. Then lastly, inspection. So inspection and observation, they are a bit synonymous, right? Sometimes they're used interchangeably. But inspection, simply you go to the client's business, you look for specific items, right? You look for specific items. So if it's observing the CCTV in the particular warehouse, you sit there, you look around, you inspect. Does this client have CCTV here? If not, okay, there's a chance that inventory is going to be stolen, right? If our client is, say, a clothing business, it's a clothes business, right? We go there, we inspect. You know, how does this company keep the safety of these clothes, right? Does any customer just come in, they try the clothes, then they put them back, you know, they make them dirty and they go away? So we observe all those things. Then we can be able to help inform our audit strategy as well as the audit plan. Any questions so far?
No questions.
No questions. All contributions?
Yeah, for contribution, I've seen when the auditors comes,
Mm-hmm.
they audit the same processes like for sales, the sales procedure. You
Mm-hmm.
find that they go down where we entered from. I don't know if you have entered from the front
Yeah.
at our company.
Oh no, I think I entered the back.
Oh, okay, okay. So
Mm-hmm.
they'll be there in front. They will actually observe how you're making a sale,
Yes.
how the money is moved from the cashier, the bank. They will follow those procedures.
Yes. All right. Okay. All right.
Yeah, so I remember them doing those, as you mentioned, the training.
All right. All right. Okay. Thank you very much. Okay.
Okay.
So now, how do we assess a risk of material misstatement? So we said risks of material misstatement. These are risks uh, that the financial statement may be misstated, or maybe they may contain an omission or an error. So how do we assess a particular risk? So one, we need to identify the risk of material misstatement. So we identify it. That's number one. Number two, we need to evaluate how that risk affects the financial statements, right? Okay. So sorry, let me just go back a bit. So I think I went far. Okay, yeah. So assessing risk of material misstatement. So this is in uh the practical industry of auditing. So one, you identify the risks during risk assessment. So an example, we have identified that the particular client we are auditing, say it's a warehouse, there's no CCTV. So that's the risk that we've observed, right? There's no CCTV. Then two, we need to evaluate whether the risk affects the financial statements, right? So now, if we observe that there's no CCTV, does that risk affect the financial statements? Then we say, okay, yes, it may affect the financial statements because inventory is being kept there and inventory is recorded in the statement of financial position, right? Then step three, we need to relate the risk to what might go wrong at the accession level, right? We need to relate the risk to what might go wrong in the statement of financial position or in the statement of profit or loss. So now we've observed that there's no CCTV. Okay, cool, there's no CCTV, right? So it means inventory is not secure, inventory is not safe. So if inventory is not safe, it means somebody can come and steal that inventory and there'll be no record whatsoever. So if there'll be no record whatsoever, when you go to the statement of financial position, that inventory figure that we have, there are chances that it might be wrong. The inventory that's recording might not be actually present because the head office where they're preparing the financial statements is far from the warehouse. And they might record inventory as being present, but in actual sense, that inventory is not present, it has been stolen. And if that's the case, then it means there is a misstatement. And that misstatement is material, right? So now, at step 4, this is where we sit and analyze and consider the likelihood of the risk causing a material misstatement. We analyze and assess, okay, what are the chances if inventory gets stolen, there are higher chances that the inventory figure in the statement of financial position is going to be wrong. It's going to be inaccurate. So then there are higher chances, the likelihood, the percentage, or the probability of a risk of material misstatement is high, right? Then note below, an assertion is just a statement which management considered to be true, which the auditor uses to consider different misstatements. So basically this, you don't really have to worry about it now because as you progress with our lessons, you're going to get exposed to assertions. Any questions so far?
No questions.
Okay. Now in an exam setup, now this is specifically for the exam. How do we assess a risk of material misstatement? You have been given a scenario, right? You read the scenario. What do you do? What are the steps that you take? So step 1, you need to identify the risk of material misstatement. Step 1, you need to identify the risk. Step 2, you need to evaluate how that risk affects the financial statements, right? Then 3, you need to create a response, right? So you need to identify the risk. Then we need to evaluate how that risk affects the financial statements, either audit risk or business risk. We need to identify or evaluate how that risk affects the financial statement. Then 3, we need to respond to that particular risk. So now here, example, identification of a risk of material misstatement. Our example says, when the company receives a payment for an invoice, the accountant keeps the money in his drawer and deposits it 3 days later, right? So the accountant receives money for a payment for an invoice. Then he keeps the money in his drawer. He locks it. Then after 3 days, that's when he takes it to the bank, right? So that's the risk, right? So now we need to evaluate how the risk affects the financial statement. So there's a risk of misappropriation of assets, and the amount in the statement of financial position may not be accurate or indeed not present. So the accountant keeps the money for himself, not for the company, for 3 days. And you know, money is very easy to steal. Because I remember I was having a conversation with my mentor. He used to work for Bank of Zambia, right?
Yeah.
And he told me saying, Patrick, when I went to Bank of Zambia, when I started working, my mentor told me, here where you've come, do not trust anyone and do not trust your own hands. This money that you're seeing here, just see it as paper, right? So the point I'm trying to make here is money is can be easily stolen. So if money is easily stolen, it means if the accountant steals that particular money, all right, we receive an invoice, then amount is stolen. Since this person is the same person who makes the financial statements, who prepares the financial statements, the same person who deposits the money in the bank, they can do a little bit of creative accounting such that the amount in the statement of financial position may not be uh, actually there in the bank, right? And that's the risk. So
Mm.
the risk is that the amount in the statement of financial position may be wrong, right? So the risk,
Yes.
the cash at bank may be inaccurate. It may not even be present. So now, how do we respond to that particular risk? As an auditor, we must focus attention on substantiating the cash in the bank and the cash in hand amounts in the statement of financial position. Because in the statement of financial position, we've got cash in hand as well as cash in bank. So now we need to substantiate. How do we substantiate? We need to go to the client's business. We ask them for their books. Then we perform bank reconciliation, right? Then we also obtain external confirmation or secularization. I remember there's one time you told me about you're getting bank confirmations. I think you remember that time.
Yes.
Yes, confirmations from the bank about the amounts that are present at the bank, right? We're using the bank's
Yes.
letterhead, right? Yes, and that's
Yes.
what we do. We want to substantiate the cash amount in the bank. How do we do that? We can reperform the bank reconciliation. We say, okay, let's reperform the bank reconciliation to see if actually the money was being deposited in the bank. Then two, we can substantiate the amount in the statement of financial position relating to the bank or cash balance by obtaining a secularization or an external confirmation from the bank. And that's the way you approach the exam setting. So you first identify the risk. So you write down, you know, the risk. You identify it first, right? Then two, you evaluate how that risk affects the financial statements. So sometimes it can be a business risk. So you say maybe the industry is very competitive, right? So you tell the examiner the industry is very competitive, and it means the company might there's a chances that the company might have low profits due to the high competition. And when a company has low profit, it means they will not be able to meet their long-term and short-term obligations, and which means that it's going to affect the going concern of that particular company and the chances that it might go out of business, right? Now,
Yes.
then you see, how do we respond to that particular concern, right? We need to go and inspect we need to go and inspect the systems in relation to how the company makes the sales. You know, how efficient and effective is the company in making its sales? You know, what strategies has it put in place for it to be able to uh, respond to these changes or negative shifts in the industry that are going to affect the particular entity? And this is how you respond. But with when we go through questions, you'll be able to actually understand it. But this is the particular steps. You have to tell the examiner the risk that you've observed, then you evaluate that risk and tell the examiner how it affects the financial statements. Then you actually create a response to that particular risk. Any questions so far?
No questions.
Okay, so at this stage now we're going to look at fraud and error. So these are two important concepts that you also need to understand very well. So what is fraud? Fraud is an intentional act to obtain an unjust benefit. Fraud is an intentional act to obtain an unjust benefit. So something that is not uh, your own, something that's not yours, but you use you use deception so that you can obtain that particular benefit in an unjust way. So basically, fraud is an intentional act to obtain an unjust benefit through deception. You lie, then you obtain a benefit which you do not deserve. Then fraud risk factors. Fraud risk factors are factors which are indicative or provide an incentive to commit fraud, right? So fraud risk factors are basically factors which give you an incentive to commit fraud. So for example, there's no CCTV in the warehouse, right? So if there's no CCTV in the warehouse, the person who's managing that particular warehouse is given an incentive to steal because no one is going to see him. No one is going to bring him to book. No one is going to hold him accountable. He can steal whenever he wants. So it simply means that is a fraud risk factor. It gives an opportunity for an employee or any other person to commit fraud. Then error. Error is an intentional misstatement in the financial statements. For example, entering a wrong amount in the wrong account, right? So that's an error. It's an intentional. You didn't mean it. Maybe due to human error, you make a mistake. You write the wrong number. You record the wrong number, or maybe you make a payment to the wrong client. That's an error. But if it's intentional, it's not an error. It's called fraud. So now, what are the components of fraud? Fraud has got two major components. There's one, fraudulent financial reporting. Then two, there's misappropriation of assets. So fraudulent financial reporting is an intentional omission or misstatement in the financial statement so as to mislead the users. So basically, you are an accountant, you steal. Then to hide your stealing, you know, you you falsify documents, or you manipulate documents, or you change accounts, so you steal money, and then you create a fake double entry, or in other words, you steal money, then you create a fake uh, receipt, right? That usually
Yes.
happens. Yeah, that usually happens. Where you steal money, then you create a fake account. I think I'll give you a practical example. When we're doing surveys, right?
Mm-hmm.
So when we go to surveys, when we go for surveys, usually the supervisor is given a lot of money for fuel. So they're given maybe 20,000 specifically for fuel, right?
Yeah.
So now, when they go to a filling station, what they do, they talk to the fuel attendant and tell them, okay, I'm buying fuel for 2,000, for instance, for two
Mm-hmm.
tanks. Then they tell them, okay, write a receipt for 3,000.
Even 5,000.
You see, yeah, even 5,000, right? So now, in that moment, they are obtaining an unjust benefit through deception, right?
Yeah.
So they steal and then they what? They falsify the documents, So now us, when that happens, we just observe. We're like, oh, okay. Even us when we become supervisors, that's what we'll be doing. Eh? Okay, you see, yeah. So yeah, so that's fraudulent financial reporting. It's an intentional omission or misstatement in the financial statement so as to mislead the users. So you just falsify, you manipulate the accounts, so that you mislead the users, so that you mask or you share or maybe you hide that particular act that you've carried out. Then there's two, misappropriation of assets. Misappropriation of assets simply means theft of the company's assets by an employee or a manager of the company, right? So when an employee steals, instead of saying stealing, you say misappropriation of assets. So that you show the auditor that you know what you're talking. You show the examiner that you know exactly what you are talking about. So misappropriation of assets simply means stealing of the company's assets by the employee or a manager of that particular company. Okay, let's look at fraud and the auditor. So what are the auditor's jobs? in relation to fraud. So the auditor's job is to identify misstatements relating to fraud, right? So now, evidence relating to fraud can be obtained in several ways. You remember I told you that you're going to be coming across inquiry, inquiry,
Mm,
inquiry,
right.
evaluate,
Yeah.
obtain. These are the keywords that you're going to be coming across. So the auditor's job in relation to fraud is to identify misstatements resulting from fraud. So now, how do we obtain that particular evidence? So we inquire. So one, we inquire from management about the areas which may be vulnerable to fraud. So we ask the auditors, or sorry, the management. We just go there, we ask, okay, in your business, in this company that you have, which areas do you think can be vulnerable to fraud? Then they tell us, no, I think our warehouse. Our warehouse is managed by this and this person, and that person works there alone, and we haven't yet installed CCTV. So I think that particular aspect of our business can result to fraud, right? Then you also inquire from management about the possible areas in the company where fraud might happen. We ask them, okay, where exactly can fraud happen? Then they tell, I know, I think fraud can happen at the till, right? Because the cashier can be able to steal money there, and then they tell us, no, our client didn't pay, but they've just stolen the money. Then you ask that particular company, the management, you ask them, where exactly might fraud happen? Then they'll tell you, I know, I think there and there and there and there. Then you also inquire from the internal audit function about the internal control around the fraud, and the auditor must test the controls. So the internal audit function is basically a function in the particular company that ensures that the controls of the entity are working appropriately. So as the external auditors, we come and examine the controls of the entity once a year, so that we create an opinion. But the internal audit, their job is to constantly review the internal controls, so that they ensure that the company and its systems are operating properly. Now, so we can go and ask the internal auditor, okay, um, where do you think audit fraud can happen? What are your responsibilities towards fraud? What is your attitude towards fraud? Then you also ask him, are there any um conditions of fraud which happen? Like, do you have any idea of any fraud which happened, and how did you respond to it? That way, you'll be able to understand the risk associated with the particular client in relation to fraud, and it can be able to inform the strategy that the company can be able to put in place. Any questions so far?
No questions.
Okay, so now we go to rules and regulations. So rules and regulations, there are two types of rules and regulations. So there's those rules and regulations which directly affect the financial statements. Then there are those rules and regulations that do not directly affect the financial statements, but non-compliance may affect the going concern of that particular client. So those rules and regulations which directly affect the financial statements are: one, the financial reporting standards. Those are the rules and regulations which affect the financial statement directly. So if you go against the revenue recognition criteria, you've got an obligation which you have to pay, which you have to offset over time, you know, but you don't record it. Then that's going to affect the financial statements directly, because you're going against the provisions of the IFRS 15. So, for instance, IFRS 16, it says an asset needs to be depreciated on an annual basis. Then you in the company, you decide not to depreciate it. That's a rule that you're overriding, that directly affects the financial statements. Then those that do not directly affect the financial statements, but non-compliance may affect the going concern of the particular company. So for instance, rules and regulations that may result in us losing our practicing license, right? So the firms of accountants, right? They are told to be. I think there's a rule ZiCA put in place. The regulations that ZiCA put in place is uh, accounting firms. They're not supposed to market their their services, to exaggerate their services the way these other companies do. Sometimes companies, when they're marketing, they exaggerate their products such that they entice the customer to go and buy. But now accountants are taught to be objective and factual when they are marketing their services, if at all they market, right? So now they an accountant firm, they market their products, they lie, such that they entice the particular uh, clients. But when they perform their work, it so happens that their work is below par. It's not really as effective as they might hope. Then the client sues for negligence. Then ZiCA gets wind of that. Then ZiCA discovered saying they were marketing their products, their services, way above what they actually are. All right. So ZiCA can uh, get the license from the particular company. And that particular rule and regulation uh, affects the going concern of the company. It will no longer be operational. So indirectly, rules and regulations that affect the financial statements, uh, they need to be considered as well. I don't know if you have any questions.
No questions.
Okay, so what are the audit procedures when non-compliance is detected? So a company's got rules and regulations. Then there's non-compliance, right? So now, how do we? What are the factors which may suggest non-compliance? That this company is not complying with the rules and regulations. How do we know that? So one, the company is being investigated by regulatory authorities, right? We're being investigated. So the client's business is maybe let me see, a restaurant, you know. Then the Ministry of Health, or let me say the health department of council is carrying out an investigation. All right. So we can know saying, okay, these people are not very compliant to rules and regulations. The more practical example is ZRA comes to our company, the client's company, then they start investigating, they start carrying out an audit. You know, we ask in the business, we say, okay, do you have any issues relating to rules and regulations? Then the lawyer says, okay, we're being investigated by ZRA. Then we can have an idea saying, okay, this particular company is not compliant to the relevant rules and regulations. Then payment of penalties and fines. When the company is paying fines and penalties, then we can know saying, okay, these are non-compliant clients. Then suspicious payments in cash, right? So suspicious payments in cash simply means, okay, maybe there's some corruption that's happening somewhere, you know. If you're dealing with the government personnel, then the government official asks for a token. In most cases, you don't pay via the bank, you pay them in cash. You go with the briefcase, then you give them, right? So if there's suspicious payments in cash for unknown services or not well explained services, you can know saying, oh, um, this client is non-compliant to the relevant rules and regulations. Then transactions with companies in tax havens, right? So company is in tax haven, company doesn't pay tax, or it hides the amount of tax that it needs to pay, right? But that entity is transacting with that particular company. Then we can also know that, okay, our client is not relevant, is not compliant with the relevant rules and regulations. Then these other points that you can also look at. But for this, you can just memorize 4 or 5. Then if you're able to write 4, at least you can get like a 4 marks given the marks allocation. Any questions so far?
No questions.
Okay, so now how do we what are the audit procedures for non-compliance, right? So one, when we detect an error, or let me say we detect non-compliance in the client's business. So what we need to understand the nature of the act. What is this uh, rule or regulation which has been not complied to? You see, we get an understanding. We just understand what's happening. So, for instance, if the rule and regulation which has not been complied to is maybe relating to tax, we need to understand that particular non-compliance. Okay, what type of tax was not complied to? Is it VAT? Is it income tax? Is it property transfer tax? Is it withholding tax? You need to understand the nature and act as well as the circumstance. Then two, we need to evaluate the possible effect on the financial statements, right? So we are non-compliant. Oh, sorry, the client is non-compliant to tax. How does that affect the financial statements, right? So maybe it didn't it it didn't it did tax evasion. It didn't pay the required amount of tax. How does that affect the financial statements? It means the net profit is overstated. It means the retained earnings is overstated. It also means the total assets or total equity rather is overstated. So it means when you calculate the return on capital employed, it's also going to be overstated, and it's going to mislead the users of the financial statements, right? Then three, you discuss with the management where appropriate those charged with governance. So if you discover there's non-compliance, you discuss with the management. You tell them, okay, we found this non-compliance. What is it about? Make us understand. How did you approach it? What is the reason for this non-compliance? Then management explains. Where the explanation given by management is not sufficient, you can talk to those charged with governance. So those charged with governance, they're basically the board of directors, right? Then point number four, you consider taking legal advice if information not provided on the matter is material, right? So we discuss with management, we tell them to give us relevant information relating to that particular non-compliance that we have observed, but management is giving us insufficient information. We go to a legal firm, Makebi Zulu and Associates. We ask them, okay, look, this is what we've discovered about our client. They're transacting with a particular company in a tax haven, right? So how does this, what are the legal implications for this? Then Makebi Zulu and Associates, they advise us, right? Then five, evaluate effect on the audit opinion if sufficient information is not obtained. We talked to management. We asked the management, there's non-compliance in your company. What is this non-compliance about? Please explain for us. But management does not provide any explanation whatsoever. We go to Makebizu and Associates, they give us the legal advice. Then now we need to sit as auditors. We think of the effect on our opinion, because the auditor's job is to obtain sufficient appropriate evidence for us so that we can express an opinion. But now in this case, we haven't obtained the sufficient appropriate evidence, right? How is it going to affect our opinion, right? Then the last point, you evaluate implications on risk assessment and reliability of written representations. So written representations are just statements that management makes saying, we have given you all the information that you require as auditors for you to carry out your job, right? But now if they haven't given us the necessary information relating to the questions that we ask, because our duty as our right as auditors is to be heard and to be given information that we require by the management. But we ask them about non-compliance and they give us information which is not sufficient. So we need to assess, how does it affect the risk assessment of this business, right? And how reliable are these written representations that management has given to us? Once you assess this, then the auditor is going to know the appropriate course of action. With that said, our lesson has come to an end. Any questions?
Okay. No questions.
Or contributions?
Yeah, no contributions.
Yeah, so that's risk assessment and risk assess. Okay, let me stop. Let me stop recording real quick.